Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the podcast, we're rejoined by a very special guest, Michael Santoli, CNBC's senior market commentator. Those of you who watch CNBC know that Mike shares his extensive market experience gained from covering Wall Street for over 30 years at Dow Jones Newswires, Yahoo Finance, Barron's, and of course now at CNBC on air, as well as through articles and videos on the CNBC platform. Welcome back to Wealthy Behavior, Mike.
Oh, good to be with you. Thank you.
Yeah, absolutely. So last time we talked, you explained the role of a senior markets commentator as almost like a color commentator in sports, not exactly sharing the play-by-play, but trying to interpret and analyze, illuminate themes and patterns to give the audience a greater understanding of what's happening in the markets, economy, and companies. You know, it's a great way to explain it. In that role, you still have to make a preliminary determination of what's happening that's noteworthy that you want to analyze. So perhaps that can be our launching point. When I'm looking at things and talking to clients, I see that we've had a pullback in the S&P. The Mag 7 stocks have rolled over. International stocks are doing well. There's a lot of policy, tariff uncertainty. Is that what you're also focused on these days?
For the most part, yeah. And what I find fascinating is because it is such a news-dense environment, let's say, and just the sort of the policy proposals and speculation fly so much, it's good to test what people perceive to be the main drivers with how the market's acting or what we should otherwise have expected the market to be doing. And what's fascinating so far this year is that not too much has happened that is inconsistent with a general take that said, well, you know, in the third year of a bull market, things become a little choppier and maybe you have a little more downside corrective type activity. It's more likely you're going to have a 10% correction if you didn't have one the prior year. Post-election years sometimes have a tough first half. So all these things you could feed in and say, well, I guess the market is more or less conforming to that. You add to that, you mentioned the Mag 7 correcting. I mean, I would say for the last 8 months of 2024, the preponderance of opinion on the CNBC air with guests who invest in stocks was, boy, this market really ought to broaden out. Boy, it's only been 7 stocks. I wish it were more than 7 stocks. This is how a market acts when the biggest stocks that are worth collectively a third of the index are going down or are no longer have great sponsorship. And so there has been a broadening, but it's not the one that people expected. And they should not have expected it to be some kind of a seamless passing of the baton. It almost never is. In fact, I think there's an interesting debate to be had as to whether people should even hope for a real wholesale turnover in leadership, because that usually doesn't happen on the fly within a bull market.
So there can be a disconnect in explaining a move like that, or moves like the one that you laid out, in that investors can look at valuations, right? The people that you talk to, and they know that the U.S. market's expensive. We haven't had a pullback. The bigger names may have been priced for perfection. So at some point, you know, there needs to be, some kind of air out of the market. Individuals who I'm talking to more than professional investors will look at the news and they'll see what you, I think, wrote as an erratic policy swirl and attribute the volatility to that. How do you see it? Do you see it as more normal market mechanics, or do you think this policy uncertainty is what kind of created the tipping point?
It did. I mean, there's no way to say that it doesn't have an effect. I would just say it's just not the sole cause or even the prevailing reason that you get these oscillations. But, you know, it's also a matter of why did we get to the highs in the first place? And I think you can make the argument that, you know, we had a kind of typical growth-led bull market that was sort of in a mid-expansion type economic backdrop last year. And then you got everybody focused in on policy implications around the election. So the post-election burst in risk appetites and expectations for what policy could deliver, I think got us to a somewhat unstable high. And then alongside of it, I mean, I think it's only partially related to specific policies. It's very related to how people felt in terms of a upwelling of confidence, and that was just a speculative, lower quality stuff that started to rip as well. Now, this year, I think obviously the sequencing of policy, front loading the frictional tariffs and immigration, and this very honestly chaotic seeming manner in which they're trying to cancel programs and restrain the budget through DOGE. I think all of that has absolutely drained away the exact risk tolerance that we benefited from going to the highs in February. And I don't want to discount real world impact, because tariffs at this level that's being contemplated and with this breadth, I think are mostly, well, most of all, it's a war of choice, right? It's not like the average investor last year in the middle of the year said, boy, what this economy really needs is some trade barriers to try to address decades worth of imbalance in the flow of goods around the world. I mean, it's not really what we thought we should have, but that is, I think, exerting an impact on a market that already was going to be dealing with a little bit of a growth scare. So I think it all is sort of self-reinforcing on some level, where it's like, well, I'm a little nervous the consumer started the year slow. Companies are hesitant to give aggressive positive guidance for the rest of the year. On top of that, we might be looking at kind of the most extreme version of tariffs and immigration restrictions. So absolutely it matters. What I do think is also, though, interesting is the things that look like they are most extreme in terms of sentiment indicators are the surveys. When you ask the average person who reads the news, you feeling bullish or bearish, 60% bearish starting a few weeks ago in the American Association of Individual Investors poll. Very rare to see that much bearishness, especially when the market's just off an all-time high. So to me, that's where it's having an impact. And the real question right now is how much of that flows into actual, risk reduction in portfolios and business confidence and economic activity.
Why do you think the Magnificent Seven in particular have rolled over more than the rest of the market? Is it because of looking for an excuse to put capital to work elsewhere and seeing this as a tipping point, or is there something else going on?
I do think that this was also widely sort of acknowledged or repeated coming into this year, which is they were losing their monopoly on earnings growth based on the forecast.
Okay.
So the differential between the earnings growth there and the earnings growth of the average company or the majority of companies was narrowing. A couple of other mechanical things definitely happened, though. I think that the warning by Walmart when it reported its earnings and it gave a somewhat muted outlook forecast several weeks ago, it really did puncture this momentum factor trade. Walmart, so momentum as a characteristic of stocks had been vastly outperforming, and this is just sort of like owning the best performing recent stocks on a risk adjusted basis. And Walmart was a very large holding in all those momentum factor baskets, because usually that's every sector has some. And you had Walmart and Costco and JP Morgan within financials and Eli Lilly within healthcare, and they had all got this real crowded type of shareholder orientation. And once Walmart pulled back, it did bring a lot of those stocks down with it. The other piece of it is that one thing you could always say about Mag 7 type stocks or the biggest stocks in the NASDAQ 100 is, sure, they look expensive, but almost all their earnings are free cash flow. And if you look this year, because they're spending so heavily on CapEx, they're actually not showing impressive free cash flow growth. Microsoft free cash flow is supposed to be down year over year this year. Google, very little growth. And so I think that there's a sense out there that they're investing heavily on faith at this point in AI. And of course, you can't ignore the DeepSeek announcement in January, which seemed like it really did just throw a little bit of a wrench into the idea that the AI infrastructure theme was going to just have nothing but winners and had years to go.
Yeah, okay. No, I appreciate that. That's great. When we spoke in July of 23, the market had started to recover from the 2022 downturn, And you felt correctly, it turned out, that it wasn't a bear market head fake, but that a new bull had started, which continues to this day, given the recent correction that we've had. Does this feel like a normal correction to you, or do you feel like this is the start of something bigger?
I think the weight of the evidence continues to say it's probably a correction within an ongoing uptrend. I don't have tremendous conviction in that. I keep leaning on the broad probabilities. It's like, well, 40% of 10% corrections go deeper. Like go beyond 15%, let's say. You could sort of look at how obviously I've done some technical damage, but the 200-day moving average is still moving higher. And then you have the global performance of the equity indexes, which even though they're kind of catching up to a large degree from after multiple years of underperformance, it's tough to see a bear market starting in an instant when you still have global markets rallying like that. And then I guess like everybody else, I look at the credit markets and say, is that really up a really scary alarm about macro? And not yet. I'm open to the idea that that's not going to be a particularly timely warning if it comes. Like there's all these reasons why people feel as if corporate credit spreads are not necessarily a fine-tuned indicator anymore, private credit perhaps being one of them. So I do think that it's probably still you give the benefit of the doubt to it being still a longer term uptrend, but I don't know, it's uncomfortable because I'll be honest, there's a possibility of having this mixture of factors that doesn't look super different from early 2000, where you had that kind of huge melt up in the kind of new era growth stocks, and then the next year they have this overshoot, and then they have a sharp break. At the same time, the economy in general is kind of slowing, and now we're talking about negative wealth effects. I wouldn't make that my prediction, and even if that unfolded that way from here, I think it would be a much more modest version of it, given how valuations were and a lot of other things. So yeah, I guess I'm still sort of saying assume this is going to be more of a corrective period. But you go back to some years like 2015 and I mean, yeah, nominally that was right in the middle of a bull market, but it was no fun and it didn't really do much for you point to point. You had a couple of 15% declines or something like that, if you go into early 2016. So I think it can both be a bull market and be pretty hazardous along the way.
What do you hear from the institutional investors you're talking to? People are trying to figure out, is there a grand plan behind this erratic policy swirl, or is it just chaos for the case of chaos?
I mean, I think there is a grand plan that's being suggested by the likes of Treasury Secretary Bessent and maybe the economic advisor Kevin Hassett, which is that we can rebalance the economy in multiple ways. One, on the trade front, then make sure that fiscal deficits, you start to bend that curve. So the structural deficit maybe has a little bit of benefit. Perhaps all of that together brings 10-year Treasury yields down, which we know the Treasury Secretary wants to happen. Maybe alleviating the affordability crisis in housing, et cetera. I think the problem with suggesting that this is a fine-tuned plan is that everybody who talks about it is forced to work backwards from instant heavy tariffs at the same time we do immigration restrictions. So like nobody would draw it up that way, I don't think. And in fact, I did note that in Scott Bessent's last investor letter to his hedge fund clients, which was in January of last year, and he was very much on board with the idea that the market would go higher, in part because he felt President Trump was going to win the election and that would be a positive thing. He basically said he sees it highly unlikely that he'll actually do across the board tariffs at the same time as immigration. Like it's sort of saying like, come on, it's all going to be a threat. And then he also noted that tariffs are inflationary and should push the dollar higher, which is counterproductive to what the longer term goals might be. So all that's to say, you can make the case that there's some kind of strategic rationale, but I don't think it's got the correct proportions or the correct sequencing to really be persuasive in that way. Look, I think it's hard to escape the idea that this is a president who, for 40 years, thought tariffs could work magic, and he thinks that the global economy is a zero-sum game. And what's fascinating about it is I have a hard time believing that many investors or even politicians would trade our economy for any other country's economy among those that the president says have been taking advantage of us for decades, right?
Right.
So it's like we've been treated unfairly by these economies that are performing worse than ours. Now, doesn't mean we're not treated unfairly in certain respects, but it's like the trade in goods is is just not something that is particularly material to how the U.S. economy performs or levels of employment here.
So given that, I guess this might be a tough question, but why do you feel like maybe Wall Street's not more concerned?
Yeah, it is a good question. I mean, I do think that a lot of folks simply anchor to the notion of ultimately, a lower tax regime with some fiscal discipline. Who knows if that's even really going to actually play out? Along with deregulation is good enough. Um, Whenever and I have to kind of do this internally to make this case, as people say, why isn't the market freaking out more about something? Whatever, norm busting measure he's made, whether it is going after judges or canceling whole cabinet departments or whatever. And what I try to say is, what specifically should the market be repricing today
Mhm.
in reaction to this? Like, give me the details on how we put this in the model and say what's going to happen to cash flows or something else. And I don't think that the overall market is that hyper rational. Obviously, we react to all kinds of things, and yeah, the rule of law is pretty important. But I don't think it's easy to kind of tie it together into short term movements. I think there is some evidence, though, that if you look at how even economists, Wall Street economists reacted to the Fed this week, and suggesting that they're kind of in a bind. They kind of see risks growing on both sides of the mandate, inflation and growth, and it's therefore, I think the conviction is draining out of a lot of Wall Street forecasts. You've seen some targets come down for S&P year end,
Mhm.
and more or less, I thought that the key line from Fed Chair Powell's remarks was that I don't know anybody who has high confidence in their outlook. So everyone writes down what they think is going to happen, but it's sort of a low conviction situation. And so I think that you need to be open, I think, to a lot of different outcomes, including an outcome where you know they don't go all the way on the tariffs or something like that. And maybe that this is kind of just a really busy sprint out of the gate for the administration, and things are going to calm down at some point. Um, but yeah, I think for all those reasons. And interestingly, look, everyone's going to be scrutinizing the weekly unemployment claims to see if a lot of the government um, layoffs show up in there, or the knock-on effect layoffs. It hasn't happened yet. So I think there are these trigger points that you could say, okay, if we blow out to 300,000 weekly unemployment claims from now to like the low 200s, mid 200s, that'll get the market's attention. So as long as we're kind of operating within the bands of general expectations in terms of economic performance, we can absorb the policy noise.
It feels like there's confidence in the Treasury Secretary and his, stated goal of focusing on the 10-year yield and how important that is.
There is. Now it's worth asking how one does that,
Sure.
in terms, and
Yeah.
and so and I do think that there's arguably, and in this case has been made too, that there's some wisdom in the beginning of a new administration to sort of set expectations low for the immediate economic performance. You kind of have some time where you can not necessarily have it hang on you, and he really is a deficit hawk at heart. I mean, whether he can accomplish anything like that or not, who knows? Um, but I do think that he feels as if we just sort of had the deficit start to close up just a little bit, the bond market would take heart in that. Yields come down, and it frees a lot more up, and obviously lowers direct federal interest expense. The problem is the incremental tax cuts that they want to do within months is going to blast through that whole scenario. I mean, there's just no way to make the heavier tax cuts they're talking about look as if they're not going to take their toll, on the deficit. And then, of course, as I mentioned, when it comes to the DOGE stuff, I mean, of all the spending excesses, if you want to say there are many in the federal budget, the civilian employment total is not it. I think like 60 or 70% of federal civilian employment is in, Homeland Security, Defense Department, and Veterans Administration. And not to say they're untouchable, but that's not where these cuts seem to be directed most directly. So I think that's what's unnerving, is that they're not kind of going where the money is,
Right.
and they're trying to like score these public victories without it necessarily being productive in terms of the overall budget situation.
Speaking of Doge, Tesla stock's down, I think at least 55%, 50%. Is this purely just a protest reaction to, well, I guess the extent of it, those other stocks are down. So I guess the magnitude
Yeah.
is this
I
just
mean,
protest?
I think what it is, I mean, this stock has made a perfect mountain of a chart over the last 6 months. So it went from 230 or so near the end of October up to 460 and now back to 230 again, or 240. So essentially, you had this sort of massive manic speculative stampede into the stock, and this stock, of course, is prone to those.
Yep.
Because Musk was considered so close to the administration. It was going to be like pulling all the strings, and it was just really a vibes thing, to be honest, a lot more than anything else. I don't think it was like even people saying, "Oh, there's going to be a lot of Tesla-friendly economic policies." And then, yeah, I do think that once there was massive brand damage based on the unpopularity of Musk at Doge, and just reversed the whole thing. Now, what I find amazing is that you still at this price, it's hard to make the numbers work in terms of based on what the company's expected to earn, and the earnings estimates for this year and next year have been cut in half over the last year and a half. So it's still kind of like, I don't know, 80 times forward earnings or something like that, even after being cut in half. And so it's always required a tremendous amount of just raw belief in the stories that Musk is telling. What I find fascinating too is it's trading right back to the level where it entered the S&P 500 for the first time in December of 2020.
Oh, wow.
And so that was at $231 where we were yesterday.
Yeah, I saw at least one investor in the stock calling for him to be taken out as CEO. I don't even know if that's practical or not, given how he owns, his shares in the company. But
yeah,
I would expect maybe more of that. Where do you think we are in the economic cycle?
It's interesting. I think this has been such a scrambled cycle in general.
Mm-hmm.
We've been in this ongoing expansion, in fact, even above trend GDP growth last year, while manufacturing has been basically asleep for 2 years. And now manufacturing might be rekindling. Industrial production's at an all-time high. So I think there's this huge mismatch, like hot, cold within the expansion that's been going on. But I think it's on the mature side when it comes to household finances. You're starting to see a little bit of wear and tear around the edges. I know Capital One just had a pretty significant rise in credit losses in its credit card portfolio or delinquent loans. And so I don't think it's dire because we had such a strong starting point, and overall consumer leverage is still really low. If you look at like household financing expense relative to disposable income and things like that. But it feels like, we're having this little wobble on the consumer side, and it's hitting services, which I think is something that you have to be aware of, at least in the short term. And the travel stocks have been terrible. It seems to me when consumer confidence goes down, that's the area where it's like the easiest thing to do is not to plan your next vacation, if you're a little nervous about things.
Yep.
And so the airline hotel stocks have gotten hit. Now, the thing is, the numbers we have so far about the first quarter, personal income and spending, have been pretty healthy. And so income's up, spending down, therefore the residual is savings. And so if you get a little bit of maybe clarity or relief on the policy headlines front, there is dry powder there. So you could have one of these reaccelerations. So I don't think that it's kind of, clock is ticking loudly on the consumer or anything like that, but the lull can definitely feed on itself, and obviously employment matters a lot. I'm sort of sympathetic to this idea. Rick Reeder, the chief investment officer for fixed income at BlackRock, has been on for a while, which is, it's kind of outdated to talk of the U.S. economy in the old cyclical terms. Like the default state of the economy is just kind of like persistent service-based growth, whether because of aging, it's because of the nature of work, and the fact that we're not as levered to global trade and things like that as other countries, that you should just assume kind of a steady state lowish growth situation, as opposed to, oh no, boom is now and the bust is coming. But obviously, shocks can come, and it'd be weird to see like a real descent into outright recession when oil prices are so low, especially in real terms relative to where they've been. And as I said, consumer finances are not in terrible shape.
I think a lot of people have been focused on what we've been talking about, which is this, what's going on with the market right now, the S&P, the policy chaos, so to speak. Is there something that investors aren't paying enough attention to because those other topics are getting all the oxygen right now?
That is a really good question. What I always focus on, or maybe try to have folks focus on, is sort of how to set proper expectations for the longer term. So I feel like, we can make the case that, we're supposed to still have earnings growth this year. It's weird if the market gets in a huge amount of trouble if earnings are still growing. Maybe we'll pull it out. But, we've had this period, this 15-year period of, I don't know, 14% annualized total returns or so for the S&P. It's pretty good. It's not as, it's gone higher, but I struggle with this idea because I've somebody I keep in touch with very closely, who he is convinced that the whole kind of 14 or 16-year or 18-year secular bull market cycles are like this law of nature, and so it went from, 82 to 2000. Before that, it went like 49 to 66. And it's like you kind of have the fat years followed by the lean years. And, he figures like within a year and a half, you probably should be prepared for some kind of real downshift in what the market gives you, especially in real terms. So I guess I'm sort of aware of that. And I always feel like, well, what do you do about that? Right. And I guess it's just, don't assume the market itself is going to do your saving for you to the degree it has already. What I am struggling with too is, I feel like this has caused a lot of consternation, is I don't like the stagflation word at all, like applied to the current environment, but I understand where it comes from. What it means is like both inflation and growth, they're kind of disappointing or moving in the wrong direction. And I think for an investor, what matters there is stocks and bonds don't provide this great offset like you would expect them to as well, right? So bonds have been tough to do their job in a portfolio over the last couple of years. Arguably, that's why gold is up partly, as much as it is. And so, I guess you just have to be open to all these different outcomes in terms of how the correlations might develop from here. So I don't think that's something that people are ignoring, but I think it doesn't get a lot of focus. And then I imagine that the AI theme, we reached a sort of frenzy on that, at least as defined by the NVIDIA centric view of the world. And I just can't get away from the notion that like the value in these massive technological developments rarely stays with the hardware company, for long time. So if you go back, it was like, who was building the internet, right? Cisco and EMC and Nortel and Lucent and whatever. And nobody could get enough of what they were selling, and, et cetera. And then it became, kind of a disinflationary force of just information spreading more cheaply and applications proliferating. So I don't know when we get into that phase, but I think you have to be prepared for that idea. I mean, people are scratching their heads over the fact that NVIDIA has been dead money for 9 months, even though the earnings have surged and everything else. But hey, I go back to Apple traded at 11 times earnings after the iPhone boom because the market refused to believe it could keep up that growth level when it's a hardware-based innovation cycle. So, all those things, like be open-minded to the idea that the early winners in the AI bonanza may not be the ones that remain the big winners.
Yeah, no, I think those are two great topics. Thank you. I'm glad I asked the question. I really appreciate your time today, Michael. As I mentioned when we last spoke, I really value your insights, as do our clients. So thank you for sharing them today. Where can our listeners find you and your content?
Sure, thank you. Well, I'm on CNBC on the TV multiple hours of the day between 8 and 5. Usually, I write a column on CNBC. It's free to read on CNBC Pro, and I am on Blue Sky these days. Michael Santoli is the handle.
So you've migrated over from X.
Mostly, yeah.
Okay, great. Well, I appreciate your time. Thank you very much, Mike.
Great, thank you, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.